Good morning, everybody, and welcome to our October IFRS and corporate reporting webinar. Now, we've waited for this webinar for a long time. We've talked about it for a long time, and here we are, accounting for Australian carbon credit units. This is a very important topic, given the new AASB S2 around climate-related disclosures. And making disclosures around the potential use of Australian carbon credit units are included in AASB S2. And in our webinar next week on sustainability, we will look at AASB S2 and the potential use of Australian carbon credit units to achieve targets. However, today we pivot and we talk about the accounting side. So if you are going to use Australian carbon credit units, or if you are generating these units, if you are buying these units, if you are selling these units, what are the accounting implications in your financial statements? So the focus today is not AASB S2, that's next week, but today it's all about accounting. Thank you very much for joining us, and we hope you find the webinar informative. Now, as always, I have with me Dean Arden, who's a partner here in Melbourne, my fellow IFRS and corporate reporting partner, and he will be doing most of the discussions around accounting for Australian carbon credit units. So BDO would like to acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. And we pay our respect to elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples. So we're getting towards the end of 2025, believe it or not. So today we have our 10th IFRS and corporate reporting webinar for the year, looking at accounting for Australian carbon credit units. And then next month in November, one of our top selling, most attended webinars every year is Financial and Sustainability Reporting Update, getting ready for 31 December year ends. You know that we always have that update in May, getting ready for 30 June, and then in November, getting ready for December. So please don't miss that webinar. Whether you've got a full year end or an interim period ending on 31 December, we'll discuss all the latest and greatest. And then in December, we look at the tricks and the traps of fair value measurement. Now, fair value measurement is now creeping into more or less every accounting standard, and we look at measuring that fair value. You would have seen or might have seen that over the last number of months, BDO has published a number of articles explaining the value of position papers and the value of getting IFRS and corporate reporting experts involved to get ready for audits. So to document your thinking, your judgments, the application of accounting standards, and be proactive. We've also discussed the need to consider accounting implications as you do transactions, business combinations, etc. So this is just a reminder of all of those. And if you want to look at the services we provide and how we can help you, you can click on that link. This is the monthly sustainability webinars. Next week, I'll be looking at, will carbon credits be used? So that is the AASB S2 side of carbon credits. Today, we're talking about the accounting side. And then in November, we look at preparing your first mandatory sustainability report. Many of our clients getting ready for 31 December reporting. And then how do we make sure we're assurance ready in December? We're also continuing to run our carbon accounting masterclasses. The next one is in December. Wednesday, the 3rd of December. So if you haven't registered, please do so now. Very popular masterclass. And we've also released on our website our quarterly masterclass dates for 2026, if you want to register for any of those. I also want to remind you of our AASBS 2 disclosure checklist, which is available for you to download from our website. And there's a link there. And then on the next slide, Dean, I've articulated how we've put it together. There are the 4 pillars that we're all familiar with: the governance pillar, strategy, risk management, and then metrics and targets. But there's actually a 5th pillar, and that is some of the requirements from the voluntary AASBS 1 has been included in the appendix to AASBS 2, because those requirements, there's 31 of them, are actually applicable and mandatory, even if you're only looking at AASBS 2. So making sure you've addressed everything. There's exactly 150 disclosure requirements. So it's an extensive job. And then on the next slide, we've tried to help you to assess to what extent you're ready. You can do a self-assessment, whether you're compliant, whether you've got a gap, etc. And then a summary on the next slide on how well you've prepared. So out of all the available disclosures, how many are you already complying with? You get a score out of 150. And then you can look for assistance, and please contact us if you need any assistance. And then for today, Dean will discuss and take us through the purpose of Australian carbon credit certificates, the types of units available, who has carbon credits, what are they doing with them, accounting for these Australian carbon credit units. And then right at the end, I will also have a brief discussion on the disclosures of carbon credits, and this is the disclosures required by AASBS 2. However, if you look at the accounting, which Dean discusses, depending on which accounting standard you apply, there will also be disclosure requirements for your financial statements in those particular standards. So accounting financial statements have their accounting and accompanying disclosures. And then disclosures of carbon credits then also have a place in your mandatory sustainability report. And with the whole concept of integrated reporting, if we read the two side by side, does it make sense? So Dean, I'll hand over to you.
Thanks, Alida. Yeah, we'll push straight into it. The one thing I wanted to do today, and I know that the title of the presentation is, accounting for ACCUs, but I realised when we were putting the materials together that it's probably important to give a bit of context and a bit of understanding around where do ACCUs actually fit into the broader set of carbon credits that are available. So you'll see in AASBS 2, there's references to carbon credits. So obviously it's an international standard. It doesn't refer to any particular jurisdiction's carbon credits, but also recognising that within Australia, we've got a couple of different types of carbon credits, and they're relevant to certain legislative or voluntary requirements, and they arise out of different arrangements. So probably to give a little bit of explanation as to how we get to the accounting of the ACCUs, I thought it might be to go back a step and actually talk about some of the other carbon credits that are actually available in Australia. So a little bit of context to start with. Why do entities have or need carbon credits? So we'll start off from the very top, the Renewable Energy Target Scheme. Now, this scheme you might be aware of not only from business-related activities, but also your personal experience. So at the moment, the federal government is funding solar panels and batteries into domestic and homes. So this scheme is quite a broad scheme, and the whole purpose of the scheme is to try and move not only businesses but also households across to renewable energy sources, so either wind, solar or hydroelectric, and thereby reduce the greenhouse gas emissions. Now it aims to deliver about 33,000 gigawatt hours, so we're talking about 3.3 million megawatt hours of extra renewable electricity each year. Now that's on top of every year. So every year they're looking to actually build 33,000 gigawatts of extra power, renewable power. Now, in terms of, to give it some kind of context, that's about 1.65 million homes each year going under renewable electricity. Now, obviously, we're not building 1.65 million homes a year, but there are houses that transitioning to that, and the uptake of that scheme, the actual the domestic scheme for the solar panels and the batteries has actually been quite successful and quite a vigorous uptake of it. And I always thought it's an interesting thing. I think one of the key parts is that by adding a battery to obviously a domestic arrangement, it improves and increases the efficiency and effectiveness of that arrangement tenfold. So it's not surprising that there's been a big uptake for it, but that is actually part of that broader government policy around the RET scheme. Now, qualifying renewable energy power stations can also receive LGCs, and I'll come to talk about them in a second, but they can turn and then sell those to liable entities. Now, typically energy retailers who themselves have obligations around greenhouse gases, they themselves may have to meet that through carbon credits and actually surrendering those. But also large electricity users also have those obligations in terms of the carbon credits and also the emissions. You'd also find that companies are likely to take it out of those with greenhouse gas targets. So they might have voluntary targets, which they aren't mandatorily required to comply with, but because of the voluntary announcements that they've made around what their greenhouse gas emissions are going forward, they may be using carbon credits as a way to offset those. I'll also note that liable entities can also acquire STCs. Now, I'll come and talk to those a bit about those in a minute, but they're your small scale technology certificates, which are usually the ones that you get if you've got sufficient solar panels on your roof or another arrangement. Also, the Renewable Energy Target Scheme is also, you can get more information on that from the department's website. Aletta, did you want to say something? No? Very good. So we'll push on then to the safeguard mechanism. Now this is generally known as the ENGA scheme. So generally you'd find that when people refer to it, you hear them refer to it as that. It requires Australia's highest greenhouse gas emitting facilities to reduce their emissions in line with Australia's emission reduction targets. So it's really focused on facilities, not necessarily entities. I've estimated there the largest 215 facilities. I'm not sure if that number is absolutely correct, but it's in that vicinity. It's likely to be a smaller number of entities because typically you'd find that entities would have maybe more than one. There'll be some entities out there with more than one facility that's subject to the ENGA requirements. So, and it's applicable to those entities or facilities that are emitting over 100,000 kilotons of carbon dioxide equivalents that fall under the safeguard mechanism. So a KT is a kiloton, 1,000 tons. Carbon dioxide equivalent. It's important to remember with carbon dioxide equivalents, we're not just talking about carbon dioxide, but we're talking about all greenhouse gases. And so as a means of ensuring there's an equality between them and an understanding of the effects, we talk about carbon dioxide equivalents. Responsible emitters of facilities that exceed their baseline must manage the excess emissions by, for instance, acquiring ACCUs or SMCs. Typically, they're going to acquire ACCUs because the SMCs are particularly ones that are usually generated by individual entities and kept by those entities, and they're related to their baseline. But I'll talk about that a bit more in a minute. Or they can borrow from their baseline from the following year. Without going into the safeguard mechanism in detail, effectively what every emitter is given is basically a baseline, which is a trend towards their emissions targets. Now, what they can do is if they realise, for example, they're going to be putting in machinery or plant equipment in the next couple of years that is more low production of emissions, they might be able to borrow from the baseline in that future year, bring it forward and actually emit more perhaps in the current years in the expectation that they're going to emit less in future years when they've actually evened out their baseline. So just to give you an idea, understanding about how they manage that. Now, the third category of reasons why perhaps entities would hold on to carbon credits is because of voluntary offsetting and surrenders. So to demonstrate progress towards net zero ambitions or commitments, particularly where emission reductions are maybe not feasible or easily achieved, particularly in the short run, you might find entities actually surrendering ACCUs or LGCs or STCs rather than on-sell them. And the way they do that is therefore meeting their emissions target by a net production of emissions. Companies can report their voluntary cancelling of carbon credits in their sustainability reports or their carbon disclosure statements. And we're going to talk a bit about that later in the presentation. The Clean Energy Regulator publishes a quarterly carbon market reports, and it's actually quite an interesting little report if you're actually interested in having a look at where ACCUs go and how they're used. I'm going to actually, in the latter part of the presentation today, I've got a couple of slides that cover some of the information in there, just to give you a sense of what the kind of information is, but also to give you sort of an understanding of maybe what the ACCU market and the LGC market looks like at this point in time.
Dean, now I've got something to add, and that is on that previous slide, and I know it's common sense, but you know, common sense not always that common. If you look at that second bullet point, the round bullet point, you've got companies can report their voluntary cancelling of carbon credits in their sustainability reports or their disclosure statements. It has happened, and people have asked me, if I've generated through my activities these carbon credits or these certificates, I want to put it in my sustainability report to show that I've done this and to reduce my carbon footprint. And you have to do it at the bottom of your carbon footprint, because you have to calculate and disclose your gross emissions. Then you can put at the bottom these carbon credits that you've generated, and then you get to a net position. The one thing to remember is, if you do that, you cannot also sell those carbon credits to another entity, because then that other entity will use it to reduce their gross emissions. So we can't have two entities reducing their carbon footprint with the same carbon credit. And I know it sounds obvious, but that is a bit of a question. I've generated it and somebody else is going to use it to reduce their footprint. Perfect. But then you can't use it as well. And I come across that question quite a lot. So sorry for interrupting, but I thought I'll just highlight that.
No, it's really good. Thank you, Aletta, because that's actually an interesting context. I was actually listening to a webinar this morning. I listened to a podcast this morning on the way to work, and a gentleman from one of the mining companies was talking about that issue, and particularly about how it sort of feeds into their reporting. And his comments were, well, we don't want to be using carbon credits because what we're actually doing is paying somebody else to reduce our carbon emissions. What we want to do is focus on our gross carbon emissions and actually reduce those in a way that doesn't use carbon credits. But obviously, it was interesting that this gentleman was the CEO of a very large entity that's obviously undertaking big projects to actually reduce their carbon emissions. But as I mentioned before in one of the slides, sometimes it's not possible. Sometimes it may not be feasible. And there's going to be a benchmark at which entities sort of get to a point where they say, look, technology is such, right at this point in time, we can't reduce it any further, and so this is how we deal with it. So this is sort of where it's interesting how those carbon credits are used. They're being used differently by different entities, subject to their strategy, but it's interesting that they also want to make sure that they're actually reporting that clearly and that their users understand how they're using those carbon credits and what they mean. So no, thanks very much for that, Letta. It's really good.
Dean, at the moment, there's a lot of talk about not all carbon credits have been created equally. And in order to address that double deduction, I would say, not double counting, but double deduction, the whole push is to have you register the carbon credit. It's got a number associated with it. And if you use it yourself, it gets cancelled because you've used it. So you've generated it and you've used it. Or you've generated it, you've listed it, you've sold it, and it goes to one particular entity. I mean, you can't sell it to more than one entity. So they are building a bit of infrastructure around that. A lot of discussion around carbon credits.
No, it's actually really interesting. That leads us on to sort of now talking about actual carbon credits. So like I mentioned, the title of the presentation today is about ACCUs, but I thought actually to give context, it's probably helpful to understand all of the different types of carbon credits that are available in Australia, because the ACCU, I tend to sort of see them as like your real generalist sort of carbon credit, because they can be used by lots of entities for different purposes. But there are different types of carbon credits out there. So starting with the large-scale generation certificates, now they're available to operators of large-scale renewable energy power stations, so greater than 100 kilowatts production. One LGC equals a megawatt hour. So if you can produce a megawatt hour of renewable energy, then you are entitled to one LGC, provided you are registered to receive it and that you actually have the right capacity to actually prove that you've generated that energy. Now, to give context, 1 megawatt hour would probably power something between 250 and maybe 1,000 average Australian homes for about an hour. That's obviously subject to peak time, usages, size of the houses, and various other things. So it can vary quite significantly, but to give you sort of some context. They're typically purchased by electricity and gas retailers, large energy users, and other entities that have obligations under the RET scheme. And entities with the RET scheme obligations are required to actually procure and surrender them an allocated volume of the LGCs for the points that you just raised, about the idea that it has to be surrendered, otherwise it's being given to somebody else who will then apply it against them. So there's no double counting of the arrangement. You've created the LGC, you've surrendered it. It ensures that then you've met your obligation in terms of the usage of the carbon credit. Now, if we look at small scale technology certificates, these are the ones that entities, if you've got enough panels on your roof, enough solar panels on your roof, you could potentially be the recipient of those. Although, interestingly, we are seeing some interesting business proposals being used in the market at the moment where entities are installing solar panels and perhaps batteries onto entities, onto domestic roofs, but in the same way of trying to minimise the cost to the as the government is trying to minimise the cost to the household. What these providers of the solar panels are doing is actually saying, well, if you give us your STCs that you're going to earn through these panels, and if you can give us, if you pay for the energy through us, we'll give you these panels for a period of time, and then once this arrangement's finished, you could get to keep the panels. So effectively, they're using the STCs to actually pay for, in part, the panels. So we're seeing a little bit of that going on. The STTs are generally to the domestic side, so they're smaller scale. Solar PV, solar batteries, air source heat pumps. So for entities that are registered and have those facilities to generate renewable energy, they can get the STCs. So they're similar to LGCs, except that obviously they're a different type of consumer or a different type of producer and a different type of scenario, but in principle, very similar. Now come to the Australian carbon credits. They're available to entities running eligible emission reduction or carbon storage activities. So that's really important part to keep in mind. So what we've been talking about is energy producers up to this point in time. Now what we're talking about with ACCUs are those who are running eligible emissions reduction and carbon storage activities. Types of ones we see, entities applying new technology or upgrading equipment, they're changing business practices to improve productivity, and probably the one I see most, maybe just for my personal activities, is the vegetation use, so the way it's managed and used. So you're seeing entities closing off sections of native forestation and basically registering that as a carbon sink and getting ACCUs based on that. And we are seeing that both in for-profit and not-for-profit entities. So it's not just a for-profit thing; it's also a not-for-profit thing as well. To get one ACCU, you've got to produce you've got to emit capture 1 tonne of carbon dioxide equivalent. ACCUs are either Kyoto, so they're usable to meet the climate targets under the Kyoto Protocol, or non-Kyoto, so they're usable for domestic and voluntary markets, and they're held and managed through the Australian National Registry of Emissions Units. Now that's effectively it's almost like the blockchain of carbon credits. It's the way that which the ownership and the transfer of carbon credits is actually generated through through the registry. They're typically purchased by entities subject to the safeguard mechanism, and we'll see that in a minute. I've got a couple of slides that can show that as a consequence of the industry that they're in, the facilities, and the fact that they emit carbon dioxide equivalents. Now we come to the safeguard mechanism. Now the safeguard mechanism caps emissions from Australia's largest industrial facilities, requiring them to stay below a declining baseline using the ACCs or the safeguard mechanism credits. So safeguard mechanism credits is effectively the credits that these entities that are subject to the safeguard can generate for themselves or for other entities that are subject to the safeguard, and can trade them to those and use them for that purpose. So to use them to manage their baseline and their emissions around those requirements. So unsurprisingly, 1 SMC is equal to a tonne of carbon dioxide emissions below a facility's baseline. So we'd like to talk in, we'd like to talk in tonnes, and we'd like to talk in megawatts. Entities can bank SMCs, particularly if obviously you're subject to the baseline, for future compliance needs, or sell them to other entities under the safeguard mechanism. They're not usually sold to other entities other than those that are involved in the safeguard mechanism, because they can't be used in the same way as what these can be used for, those entities. Held, managed and traded through the same accounts. Again, it's just to manage, it's like the blockchain of these the carbon credits. It's a way of managing who owns what and when. So who has carbon credits and what are they doing with them? I thought this is really, I wouldn't take anything, this is just a summary slide. I picked this off the front of, it's effectively what happens is quarterly, the Clean Energy Regulator publishes a carbon market report. So this one is the quarter 3, so for September 2025. This is the front page. I just thought I'd just highlight there because there's actually quite a lot of good information in there. I don't want to go into detail there, but I wanted to highlight the fact that there's actually quite a lot of data about carbon credits being captured by the Clean Energy Regulator, and they publish it quite regularly. So it's quite, if you have any interest in carbon credits, where they are and what they're being used for, I think it's actually quite a good source of information. So this is a pretty cool little diagram that I picked up out of their recent report. As you can see in this, and the question's being asked, well, okay, who holds all the ACCUs in Australia? As you can see there, the big chunk of the ACCUs are being held by that blue group, which are the safeguard mechanism related entities. And that's not surprising, and it's interesting too that you can see that it's actually increased quite dramatically over time. So the proportion of them is increasing, not only the absolute amount, but the proportion of them being held by safeguard related entities. So you can see that what the ACCUs are, they can use them obviously to offset their obligations under the safeguard mechanism, but they're all like, the ACC is like an all-purpose sort of carbon credit in the sense that it actually can be applied here for them to be then in turn surrendered or actually maybe sold if for example, they can reduce their baseline without having to use those carbon credits. So you can see there from that diagram too, there's a significant portion of the ACCUs out there basically sitting with intermediaries. Now that could be entities that are themselves in between using them and not using them. It could be acquired by people that are just in the market where they're facilitating contracts in power purchasing agreements or any other things that generate these sort of things. And ultimately there at the baseline, you can see there that the project proponents, so it's not unsurprising that there's the entities that are ACCU scheme registered have quite a significant portion of the ACCUs generated as well. This is a cool little diagram too. I thought it'd be helpful to actually look at. Why are the entities surrendering them? And it's interesting, you can see it's a bit all over the shop over time, but there is definitely some trends in there you can see. The voluntary surrendering obviously is steadily the most significant way in which entities are using ACCUs over time. You can certainly see over time too, moving from 2020 to 2025, the number or the proportion of the ACCUs that are being surrendered for voluntary purposes is increasing. It's interesting if you sort of, it doesn't sort of bear out so much in 2020 and 2021, but if you look at sort of 2022 onwards, you can sort of see how entities, particularly the voluntary surrenderings, are working, and you can probably align the patterns with mid-year and end-of-year financial reporting, which often coincides with their compliance requirements as well. Which you can sort of see in Q1, going from 2022 onwards, you can sort of see in Q1 they surrender a certain number. Usually in Q2 they'll surrender a bit more because they'll get themselves up to where they need to be, and then in Q3 they'll make an estimate and they'll surrender a certain number, and then Q4 will be almost like a true up to make sure that they've got all of the ones that they've surrendered that need to for their either, you know, for their mandatory or in this case we're talking about voluntary surrendering. So in cases where they've actually identified their own emission targets that they want to achieve. Government, you can see sort of off and on, picks up some, doesn't pick up. The compliance side is obviously starting to steadily grow as well, and so you can see why they're surrendering them for that purpose. Another quick one, I just sort of compare that to the LGC. So the previous slide was ACCUs, now LGCs. LGCs, obviously they've got a different source, and so they might be held by slightly different entities. But you can see very, very evidently from this graph that the use of LGCs as voluntary for the purpose of voluntary surrender is increasing quite dramatically over time. You can see there's certainly a government of picking them up, but obviously that makes sense in the context of often governments are involved in electricity production. Also, the government has been picking them up. They were auctioning them up to a point a couple of years ago where they were actually buying them, so entering into contracts with renewable energy providers and actually acquiring those LGCs that they're producing for their own purposes. but not necessarily always surrendering them, as a way of supporting the market. Just for out of interest, I thought I'd throw in there this little diagram. It talks about and it shows what the price, the weighted average prices for ACCUs and the safeguard mechanism credits actually have been doing for the last couple of years. You can see that the market's really starting to sort of trend towards a more consistent pricing mechanism. So obviously at the start it was a bit all over the place, but now certainly trending towards it. You can see there's slightly different pricing for the the safeguard mechanism credits as compared to the ACCUs. Not surprising, you would expect them to be close in price though, because they are relatively substitutable for the entities that are most likely to use them. The other thing I think I just wanted to maybe take away from this is that, often when we see graphs around prices using weighted averages, often that indicates that the pricing, if you start to look at volume v price movements, that might indicate that the market is not as active as it possibly could be. I think the general thinking at the moment is that the market for these prices is not active, because and maybe if I go back to one of the previous slides where you looked at who actually holds a lot of the ACCUs, those entities are holding them to surrender. So the market itself is quite large, but probably the number of ACCUs that are actually hitting the market is relatively small. So as a consequence, we tend to take the view that these markets are not active at this point in time, probably because of the nature of what these products do and who's actually holding them. So when we're talking about all of that, take us to the accounting for ACCUs. There isn't an accounting standard for ACCUs. So whenever we're confronted with a situation where we don't have an accounting standard for ACCUs, we do what we call, we appeal to the hierarchy. So we go into AASB 108 and we say, look, what accounting standards most look like what we're looking for and which ones best suit us and the most relevant and helpful, producing the most useful and reliable information that we can find. And when it comes to ACCUs, and I'll leave the other types of carbon credits for the time being, when we're looking at ACCUs, we tend to find that okay, it's the purpose for which they're being held is often will drive exactly what the accounting will be. And as you can see from the previous slides, entities are either sort of holding on to them for a period of time, or they're actually, surrendering them or actually selling them. And so inventory versus intangible assets seems to make the most common sense when we think about what classifications they should be. Now that's helpful because it sort of sends us in the direction of, okay, what are the accounting, what should the debits and credits actually be? But it's not actually definitive in the sense that sometimes it's actually have to work through the debits and credits to get a better understanding of them. So let's do that. Best bit of advice I always think when I'm thinking about accounting for me, and it's a thing I do for myself to make sure I don't make mistakes, is I think I have to remind myself, who's the entity? Are they for profit or not for profit? And have they got an accounting standard that applies to them, specifically as a for profit or not for profit? Or is there requirements in the accounting standards that apply to them differently if they're for profit or not for profit? So we start with the idea that we classify these assets as either inventory or intangibles, and we go, okay, if I'm thinking about purchasing ACCUs, I'll look at the inventory standard. The inventory standard says, well, if you purchase something, it doesn't make a distinction between necessarily whether you're for profit or not for profit. It just says, if you've purchased it, what's the cost? And so you recognize the cost. And the same with, thankfully, for the intangible assets. So when you go to the intangible asset standard, you have a think about it and you say, okay, are they for profit or not for profit? Yes, for profit or not for profit, but how are we acquiring these intangible assets? We're acquiring them because we're purchasing them. Okay, so AASB 138, pretty clear. It says, yeah, the cost again. So we've got a good handle on purchasing. Usually the cost is a one. So it's the accounting doesn't get too tricky at that level. Then if we start to move through the initial recognition and measurement, and we are producers, which is a slightly different scenario, then we have to start to think about for-profit versus not-for-profit and how we're getting them. So the distinction I talked before now, if I purchase them, I'm acquiring them in a transaction from somebody, I'm paying cash or consideration of equal value for whatever they are. Now, if I'm producing them, it's likely that I'm producing them from assets that are not necessarily, that I can't necessarily identify the cost from straight away. So if I just look there, we concentrate on the left-hand side of the screen, so it's classified as an inventory. If it's been allocated by the Clean Energy Regulator, so let's assume that I'm I can generate ACCUs because I've got a piece of land that's set aside and that it's a carbon sink. Now I'm generating ACCUs from that land. It's within the scope, and I'm for profit. It's within the scope of AASB 120. Okay, there's a standard that talks about government assistance and government grants. It's applicable to for-profit entities, so I'm dealing with 120. So I'm in the right standard. I'm thinking about the right thing. When I start working my way through AASB 120, I find that a government grant. Now, if you think about what this is in fact it is a government grant. If I'm the owner of the land, that's the carbon sink, I'm be registered as an ACCU scheme person, like the entity I'm involved in running that scheme, then the Clean Energy Regulator will be, when they allocate those ACCUs, will be allocating to my account within the registry. And so therefore I'm acquiring them. When you think of it that way, I'm acquiring them for nothing. The Clean Energy Regulator is a government entity, and so this is a government grant. So I'm probably skipping a few steps, but just for simplicity's purposes, I'm just sort of identifying the key sort of areas. And we think about that and we say, okay, so if it's a government grant, it takes the form of a transfer of a non-monetary asset. ACCUs are non-monetary assets. They're just a carbon credit. They could be worth something today or something tomorrow, but I can't, there's no monetary item to them. The government's not promising me cash for them. In that case, I've got a choice between initially recognising them at fair value or nominal value. Now, I think in CRI, we've done a couple of articles over the last 12 to 18 months and talking about what we think the accounting should be, and we've outlined this. Certainly, I think we've indicated in those articles is that we think fair value is actually probably from a user's perspective is a much more useful piece of information. Because if you think about it, it's zero if you attribute a zero to it, particularly at the moment if entities are getting into schemes, and one of the reasons they're getting into the schemes is because of the ACCUs, then you'd expect your users would want to be able to see what the financial impacts of that is. And so having them at fair value is obviously a much better approach than simply just attributing zero value to them, because if you attribute zero value to them, there's the prospect that you're not going to see them in the balance sheet or the P&L. So there is obviously, though, within the standard AASB 120, there is a prospect if you apply a nominal cost approach to them. The idea is that you might be able to determine a cost for them. So if you think about, if I'm producing, and I'll step outside ACCUs for a second, if I'm producing electricity, there's a cost to running, the renewable energy production. Is it possible for me and feasible that I can actually determine a cost for that based on the cost of running that renewable energy? Now, it's feasible. I'm aware that entities do it, but obviously that requires some fairly sophisticated cost accounting to be able to identify exactly what that particularly that byproduct, because if you take the view that the electricity being generated, and I'm stepping outside of ACCUs here for a second, but if you think of it this way, if the electricity being generated by the renewable energy source is costing you money, and that's generally the primary purpose of it, it's to produce electricity, the ACC, you might take a view as a byproduct. How do I allocate the cost between the main product and the byproduct? That's one way of doing it, but obviously that requires some really sophisticated internal management accounting and probably some sophisticated estimates about what the actual cost of it is. And so it's not uncommon now to actually see entities just saying, I don't know what it is. I'm not going to go into that level of it, knowing full well that I've got a fair value that I can pick up in terms of I've got a market price, and I'll pick up that from that point in time. When it comes to intangible assets, though, it's a slightly different one. So if you actually just realise that you're acquiring the ACCUs not necessarily for the purpose of resale or for use in production, you might think I'm just going to sit on them. You're a not-for-profit entity, for example, or a for-profit entity that you sort of think I'm just going to sit on them for the time being. Then I'm going to apply and classify them as intangible assets. Now I'm in the scope of, sorry, I missed that one. It's intangible assets, sorry, and it's still within the scope of 120, but obviously you've got a slightly different approach to them because you've got this issue of you've got an intangible asset. So you're still faced with the fair value of the nominal amount account, but when it comes to the actual intangible assets, you've got this issue of consider whether or not you can reliably measure them. Now that's a slightly different sort of concept than what it is on the inventories. Because the reliable measurement implies that you can actually determine the cost for them. Now, often that will be really quite challenging. And so from that perspective, under AASB 120, again, we'd probably suggest look, fair value is probably the appropriate way, because otherwise it's going to be quite a challenge to actually try and determine that cost for an intangible asset in that context. Now, if we push on now we think about not-for-profit entities, classified as inventory under the ACCUs scheme. It would be in the scope of AASB 102, but different from the for-profit entities. It's within the scope of AASB 1058. So make that distinction. That's a really important distinction because the accounting standard does differ between the two standards. So as a consideration paid by the producer is significantly less than the fair value. So for example, you own a piece of land, it's being used as a carbon sink, you're generating ACCUs, they're being credited to your account every year. The carrying amount of the ACCUs has to be determined based on the current replacement cost under AASB 102. Now that, in some contexts, would generally lead you to the position where you might say, well, look, if I was to replace these things, it would be what I'd spend to actually acquire them. So it might be a fair value model, or it might be a market model in that sense, but you're starting with current replacement cost. And then when you've recognised the assets, you've got this issue of what's your credit. You've recognised the asset as a piece of inventory, as an item of inventory, but now you've got the issue of, well, what do I credit? Typically, what we'd find is that when you apply AASB 1058 in this situation, you're probably going to be ending up in P&L. So it might appear as a government grant, or it might appear as income, depending on how you want to describe it, or depending on the nature of it. But typically, we would expect, if there's nothing else going on with this arrangement, you'd recognise the ACCU as a piece of inventory, and the credit would be effectively to government grants or income. Now, if it's an intangible asset, again, the same issue applies, is that you are within the scope of AASB 138, but you're not within the scope of 120 because you're not for profit. You're actually within the scope of 1038. 1058. So the idea is you've got to think about both sides of the journal entry. I'm getting an asset, but I'm also getting a benefit of some kind. If you think of it this way, the asset side sort of sits within 138, but sort of the credit side sits within 1058. So again, we recognise the intangible asset. Again, we have this issue of the carrying amount is we've acquired it for nothing. Interestingly, AASB 138 does say fair value. So it takes you straight to the market value in that sense if you're a not-for-profit entity. So you recognise the intangible asset, the ACCU, at its fair value. Typically, you pick up their market price on that day. And the difference then between the credit account, you then have to recognise as per AASB 1058. Now, again, we would say, look, in 1058, unless there's something else going on in this transaction, and it's feasible that there is, there might be other aspects to this transaction. So it's not a straightforward, just simply acquiring an ACCU. There might be other parts to it, but if it's a straightforward acquiring the ACCU, we generally expect to see that credit would be an income for the same reason it is for inventory. Now, the subsequent measurement of ACCUs is an interesting side discussion. When it comes to the inventory side, if you're just looking at it from an inventory, and the differences don't really make a difference now once you've moved outside of the initial recognition. So initial recognition, really important to make the distinction between purchaser, producer, and not-for-profit, for-profit, because it has all sorts of implications for it. But once you've got them on your books, the accounting's pretty much the same for both for-profit and not-for-profit purchasers, producers. It doesn't really matter. So then you're dealing with, obviously, if you've classified as inventory, you're in AASB 102, so you're actually talking about the lower of cost and net realisable value. So what the implication for that would be is that, maybe, for example, depending on how long you're holding for them, you might have to consider, maybe movements in the market price for them as an indication of what they're worth. But generally, you'd be recognising, obviously, a cost unless there's an impairment, effectively an impairment loss on them. When it comes to intangible assets, it's a very different scenario. So you're saying, well, look, isn't it from an intangible asset perspective, I would possibly be able to, leverage the revaluation model in 138 if there is an active market for these. And as I've said, there's general opinion out there is that there isn't at this point in time an active market. And I think that's evidenced, I suppose, by a couple of things that the diagrams I've shown today. So one is that there's quite a large proportion of these ACCUs sitting with the safe hold mechanism entities, and they're not trading them. They're effectively surrendering them. So in that situation, there won't be a market for that ACCU. Those ACCUs are actually being taken out of the market. So that's going to really make an impact on the activity of the market. But also the weighted average asset price aspect to it as well. So, that there might not be necessarily trades as frequently or regularly as you might for other products. And I thought one of the other diagrams showing, the movements sort of, month by month and quarter by quarter also might help to understand that, maybe there's periods in time where ACCUs are just not traded because entities are just sitting on them waiting for the next compliance level that they have to deal with. So from a perspective of accounting, once you've classified it as an intangible asset, you're dealing with it at cost, and you might have to deal with the impairment aspect to it. We generally wouldn't expect there to be amortization on the basis that the asset doesn't have it has an unlimited useful life until you obviously surrender it or until you sell it. Interestingly, though, when we start to talking about surrendering, that can sort of bring into some interesting accounting questions as well. So I've listed there a couple. So sold or transferred to another party, pretty straightforward, but the accounting slightly differs depending on whether you've classified it as inventory or as intangible assets. So if the inventory, you recognise as an expense in the period in which the related revenue is recognised as per AASB 102. Whereas if you're talking about intangible assets, you don't actually record separately the consideration paid for an intangible asset. So under AASB 138, if you sell an item of intangible asset, you're only recognising the gain or loss. So it's a net figure that you're recognising as opposed to the gross amount if it's inventory. Voluntary surrendered, well, if you voluntarily surrendered it, you're effectively given it up. What happens is the legal effect of that is effectively the Clean Energy Regulator takes that ACCU with a number on it, takes it out of the system. So it's no longer recognised as an ACCU. You've surrendered it. If you surrendered it, the idea would be obviously you're not paid for it, so there's no consideration to recognise. So it's a loss. There's not much, unless you're doing it, unless you're surrendering in, and it could potentially be capitalised to another asset that you say you surrendered it for the purpose of creating an asset. That might be a situation where you can actually capitalise it to that asset. However, if you're just simply surrendering it as a means to meet a regulatory requirement, we'd expect that there'd be simply a loss in respect to that ACCU. Now, when it comes to the safeguard mechanism, it's interesting. So, the diagram I showed you before, quite a lot of the safeguard mechanism entities have got quite a strong hold on the ACCUs, and they're holding them for effectively the safeguard mechanism obligations. If they actually got an obligation as well, you would tend to see, and it depends on the timing, and I've sort of tried to explain it there, but it depends on the timing of your reporting period vis-a-vis your regulatory period. You may or may not recognise a provision in your financial statements in respect to your obligation around the safeguard mechanism. So if it all lines up, say for example, if your reporting period ends after your regulatory period, you might be putting in your books the fact that you've got an obligation that you might have to recognise in respect to surrendering them. That provision, when you actually surrender the ACCUs, would then be derecognised, as would your ACCUs. There has been some discussion in the industry around what that provision should be measured at. Should it be measured at the carrying amount of the ACCU? So, I'm giving up what I paid for this and the provision is met, or should the provision actually be measured at the fair value of the ACCUs, because that's the equivalent of what you would have had to surrender to actually to remove that provision from your balance sheet. So there's a bit of discussion around that, so beware of that as well. I thought I'd just throw this one in here because it's one we do see often. It's a bit more complicated, but I thought I might throw it just in here for the sake of being able to compare and contrast. So what we often do see with entities that enter into PPAs is that often there's a part of the PPA, if an entity enters into an arrangement with another party to generate electricity, and if they do buy quite a lot, if not all of the electricity generated by the producer, they'll often be in arrangement where they'll acquire the LGCs as well. Now, they won't be ACCUs because obviously ACCUs are only to do with carbon capture. LGCs are generally the ones that are created as a consequence of renewable energy generation. So there'll be some arrangement in the contract that says, as a part of buying these, in part of buying these, the electricity generated, we'll also take the LGCs. Now, one thing we do see is that obviously in that kind of situation, there's two products being produced. There's been the electricity and the LGCs. The question is always, the timing of those two things will probably be different, and the value of those two different things are going to be different. And so how do we account for the fact that we've got sort of two transactions in the one contract? The general theory and the general approach across the market is that obviously you have to use some kind of pricing or valuation process to split out the value of the LGCs from the value of the electricity. That in itself can be challenging, particularly if if it's not a fixed price for the electricity over time. If it's a fixed price for the electricity over time, you can generally do the split pretty well. But if you've got these conditions within the agreement that sort of split that change the period of the timing of the payments, so maybe you've got peak versus non-peak, maybe you've got sort of resetting prices, maybe you've got take or pay arrangements. All of these things make the pricing a little bit more difficult to predict, and therefore can make that allocation between the fair value allocation between the LGCs and the power challenging in itself. But generally what we do see in the market is entities splitting that on a relative fair value basis, and they might use some forward pricing or some future pricing arrangements to actually try and estimate what those things are going to be in the future. And it's not unlike often what you see. It's not unlike when we have multiple goods and services being sold in a customer contract. We do the same sort of thing. We do a fair value valuation of the components, and then we do a relative pro rata based on the relative prices. I just thought I'd throw that one in there just so people sort of, you can get the understanding of, okay, we don't often see this in the context of ACCUs because generally entities doing. However, it is possible that you might. I can see in the future that some entities that are generating good numbers of ACCUs from, say, carbon sinks might actually look to sell or pre-sell those, and that's going to create an issue around the accounting because you've got this obviously large cash payment up front, and then how do you deal with the ACCUs flowing out over time, and therefore recognising maybe what that income is over time. I think that takes me to the end of the accounting. Aletta, if you wanted to talk a little bit about the disclosure.
Yes, and maybe to just recap, we're talking about the disclosures here under AASB 2. All the accounting standards that Dean has talked about, whether it's inventory, whether it's an intangible asset, whether it's a government grant, all of those standards have their own disclosure requirements to be included in the financial statements. So we're not here discussing those disclosure requirements. We're just trying to connect the accounting with what Dean's just done with the actual disclosures in the mandatory sustainability reports. I just want to make that clear. What I've done here is I've just taken an extract from our disclosure checklist, and I've given you a link earlier in the presentation. And there's a number of disclosures. These are the last disclosures in AASB 2. And it's all set up by, you've told us about your governance, you've told us about your strategy, you've told us about your risk management, you've told us about the metrics you've set. Very importantly, you've told us about your targets, potentially targets around reducing greenhouse gas emissions over time to align with the Australian targets, etc. But if you set targets, you could either achieve those targets by actually reducing your emissions, so reducing gross emissions, or maybe you are unfortunate that you're in an industry where we don't have the technology and the innovation yet. So in order to meet the targets, especially the mandatory targets through the safeguard mechanism, the only option you've got to meet it is that you have to plan to buy carbon credits or offsets in some form in order to get there. And if that is part of your plan, it's therefore part of your strategy, under AASB 2, you have to tell the user about it. So make it very clear, these are our targets, and we are planning to get through by buying carbon credits, or we are planning to reduce some of it and reduce the gross emissions, and that we can't reduce, we will buy carbon offsets. So all these disclosures are focusing on that. So for each greenhouse gas emissions target, has the entity disclosed in its planned use of carbon credits to offset greenhouse gas emissions to anyone, so very specific requirements, and then you can mark whether you've got it in place and what information you need. On the next slide, Dean, we've got the rest. I think it's 4 year and another 3 on the next slide. Again, number 43, for example, for each greenhouse gas emission target, has the entity disclosed whether the underlying offset will be nature-based or based on technological carbon removal. So a lot of information, 7 specific disclosures around carbon credits. So that really rounds off the session today. If we go on to the next slide, Dean, I think here you've put in some examples of some of the disclosures we've seen. This is from the Rio Tinto 2024 annual report. I would say, remember, AASB 2 is a new standard. The first entities will be complying with it for 31 December 2025. So although this is a good disclosure, I'm not trying to say it's compliant with AASB 2 as yet, because they didn't have to comply with it in 2024, but it gives you some idea of what it could look like.
Yeah, I was going to say, I just don't, nobody please read into any of this. We're picking on Rio Tinto. I only picked them, and I'll take responsibility for it. I picked them as an example because I'm aware that they have recently entered into a power purchasing agreement to try and power some of their aluminium factories going forward. And so I knew that they were in the area where they were picking up these things. So I had a quick look through their financials, saw that table, and I thought, oh, that's a good little table to start with. But as Aletta says, obviously this is not necessarily S2. It's just sort of giving you an indication of what it might look like under the circumstances. But you know, good on Rio Tinto for having a go at it.
Yeah, and it's a voluntary disclosure which is useful to the users. So absolutely good, but not AASB 2. Then if you need any assistance, so around IFRS corporate reporting, accounting advice, as I said earlier, we've got on our website the kind of things we do, the position papers we prepare. If you want us to prepare a position paper around accounting for any of these credits, please reach out. This is just our national team, all the partners in our national team. So we've got Clark in Brisbane, Kevin in Sydney, Dean and I are in Melbourne, Lynn in Adelaide, and Ashley in Perth. So please feel free to reach out to any of us. Our monthly newsletter, Corporate Reporting Insights, and also sustainability news, you know, come out every month. I think Corporate Reporting Insights was published last week, Thursday. Please register for these. We try and keep you up to date. There's been a number of articles around accounting for carbon credits if you want further details. And then obviously on our website, as you know, at BDO, we believe in education and learning. So there's a lot of e-learning available. For sustainability reporting, I can't not talk about sustainability reporting. It's impossible. We can help with carbon accounting, actual sustainability reporting, AASB 2, or even voluntary reporting. We can help with decarbonization strategies. And then also our audit partners provide us sustainability assurance. And then I think over the next 2 slides, Dean, I've put in the people to contact. So similar to IFRS and corporate reporting, we've got partners across the country. So carbon accounting, those are the people you can contact in the different locations, or sustainability reporting. And these are the key sustainability assurance partners across BDO Australia. Of course, in any event, please reach out to Dean or I, and we can channel you to the right people to be able to help you. Dean, thank you very much for the webinar. Everybody, thank you for attending our webinar today. I'll speak to you next week, where we look at the AASB 2 aspects of carbon credits.
Thanks, Aletta. Thanks, everyone.